Let's break down why stock market crashes aren't something to fear, but they're actually the greatest wealth building opportunities of your lifetime. Now, during stock market crashes, most people panic and sell at the bottom, and they lock in gut-wrenching losses. But the truly wealthy are calmly positioning themselves to take advantage and capitalize on these rare moments. And just like Warren Buffett said, be fearful when others are greedy, and be greedy when others are fearful. Now, here is what most people fail to understand. There is a specific timing to when you can take advantage of stock market crashes, and it has nothing to do with technical analysis, price action, or gambling. Knowing when to get into the stock markets during a crash comes down to two key pillars: central banks and interest rates. So I'm Kayan, and I've helped over 5,000 traders from all over the world understand how to invest their money in the markets using fundamentals tied to macroeconomics. And in this video, I'm going to break down exactly how we use this strategy to know when to buy stock markets during a crash using central banks and interest rates. And you're going to know exactly when to get into the markets, how to position yourself to build tremendous wealth, because stock market crashes only come around once every 5 to 7 years. Now, what I share with you, this isn't theory. I'm going to show you exactly what happened during the last 3 stock market crashes. This is going to cover the markets over the past 25 years, and I'm going to show you each and every time the markets crash, exactly when the market started to go up in value and the exact timing you could take advantage of the turnaround. So we're going to look at the 2000 dot-com bubble, we're going to look at the 2008 financial crash, and we're going to look at COVID. So you're going to see that the sequence I'm going to show you plays out time and time again in the stock markets. So tighten your seatbelts, you're going to love this one. So before we get into the fundamental strategies of how to invest during a stock market crash, you really need to just understand one simple truth. Stock market crashes always follow a very predictable pattern, and the market crash is always rescued by the central bank. So let me just touch on the patterns that plays out in every single market crash. First of all, you need to understand the value of stocks are driven by the earnings of companies. Now, if earnings of companies can continue to rise, stock markets will keep marching higher. But if for whatever reason the investors expect that the earnings of companies are going to contract, they're going to pour their money out the stock markets aggressively. And this is what causes stock markets to crash. It's a contraction in earnings, which causes a contraction in the economy, and investors pull their money out the markets. Now, this scenario plays out very early on because the economic data starts to weaken, which gives investors insights that the earnings of a company is likely to contract. So this is what causes the snowball effect of stock markets starting to tumble, and it's always based on economic data, which predicts the performance of the economy, which then leads on to the earnings of companies starting to deteriorate. So as the economic data gets worse, the panic starts to set in with investors, because if you've been investing your money over long periods of time, you want to lock in your profits in the stocks you've invested in before the stock market starts to tumble. And if the economic data is deteriorating, they try to pull their money out the markets quickly, so panic sets in. So as the stock market starts to fall, there's also a very interesting correlation to the price of gold, which also goes down in value. And this is because investors have lots of margin calls in their stock portfolios, and they have to liquidate their gold trades to put up cash to make sure they don't get closed out of their positions by their brokers. Now, central banks have a mandate. They need to control the economy. So central banks, whenever there's a market crash, they need to maintain the wealth of citizens, especially pensioners, so they will slash interest rates. And as soon as a central bank slashes interest rates, this is the floor under the market, and a stock market crash will start to level. And then you'll start to see from a bottom, the stock market starting to rise again. But it's only when central banks slash interest rates aggressively to get liquidity into the economy and start getting people spending, so the earnings of companies can return. Now, as soon as the central bank cuts interest rates, guess what happens? Gold and the stock markets take off. And I'm going to start to show you this for our history. So this pattern has played out every single time for the past 25 years, and we're going to look at the last 3 stock market crashes. Now, understanding this is going to give you a massive advantage over emotional retail traders and professional traders who will buy way too early when the markets are still falling, or people will start selling and locking in losses, and you're going to be the patient investor knowing exactly when to get into the market and take advantage. So let's look at the beginning of 2020 when COVID came into play in early February. The stock markets tumbled as soon as the news spread that there was widespread lockdowns, because investors understood immediately that lockdowns would mean that people are not spending money and the earnings of the 500 biggest companies in the United States will contract. And we saw a market sell-off of 35% in the stock markets. But notice at exactly the same time, when we look at the right screen, we can see gold price in dollars tumbled as well at exactly the same time by 15%. Now, notice in March 2020, the US central bank slashed interest rates to zero to help the economy recover from the lockdowns. And immediately we saw the stock markets turn around. If we look at the bottom of the dates, March the 23rd is when the stock markets bottomed and turned. That's exactly the same time on the right-hand side that gold bottomed and turned. Okay, so investors went straight back in to the stock markets because they know soon as interest rates get slashed, the earnings of companies are going to start to grow again because consumers are going to have lower interest payments on their mortgages, credit cards, car loans, student debt payments, and that's going to be the trigger to get people spending and a return to higher earnings for the companies in the S&P 500. Now, gold again shot up in value at exactly the same time, and we're going to cover the exact strategy between why investors buy gold at exactly the same time when they're buying stocks. Now, we saw the exact same pattern play out in the 2008 financial crash. The stock markets from October 2007 until March 2009 fell by nearly 60%. And notice at exactly the same time on the right-hand side, gold's price fell by 35% during the stock market crash. Now, as investors were losing money in their stock market portfolios, they had to liquidate some of their gold positions to put up margin to try to make sure they didn't get stopped out of their trades by the brokers and lock in gut-wrenching losses, which explains why the two fell at exactly the same time. But notice, look what happened when the Federal Reserve slashed interest rates in late 2008 down to around zero by December. We can see that the stock markets bottomed when the central bank took interest rates down to 0.25%, the exact same level that the stock markets boosted during COVID. And you can see that was in early 2009, the stock markets again started to rise after central banks slashed interest rates to zero. And again, gold took off at exactly the same time. And then the US stock market went on a 10-year bull run up until the 2020 stock market crash, and gold also took off at exactly the same time. So notice, guys, soon as central banks cut interest rates in 2020 and in 2008, that is the exact moment when investors were getting back into the markets, okay? It wasn't driven by technical analysis and it wasn't driven by price action. It was a fundamental reason why investors put their money straight back to work in the stock markets and in the gold markets. Now, we can go back even further to the 2000 and 2001 stock market crash, which was triggered by the dot-com bubble bursting, with technology companies being too overvalued in the stock markets. And then we had the 2001 terrorist attacks on the Twin Towers, and the stock markets tumbled again by around 50%. But notice, gold and stock markets were at their peak at exactly the same time, and gold went down by 20% on the right-hand side as the stock markets went down by around 50%. But notice, when the stock markets bottomed, so did gold bottom at around exactly the same time. We can see in late 2002, the central bank slashed interest rates from 1.25% down to 1%. That was the lowest level the central bank took interest rates during the 2000 stock market crash. And no surprise, after the central bank started cutting interest rates to its lowest level in November 2002, then you started to see the market start to bottom from November and start to rise again. And then the stock markets took off. But look what also happened. Gold also took off at exactly the same time again, as the central bank was slashing interest rates. So we use our macroeconomic spreadsheet where we track the key data analyzing the United States economy. But the key we have to look at is this over here called implied interest rates. We can see meeting by meeting the exact level that the markets are predicting the central bank is going to cut interest rates over the next 12 to 18 months. And when we can see that interest rates are going to hit a floor at a certain level, we know when the markets are being predicted to bottom, and that's when we're going to jump in the markets and buy back the crash. Now, we can clearly see that this pattern isn't just coincidental, it's driven by fundamental economic principles. When central banks cut interest rates and increase the money supply, two things happen. The yields, which just means interest rate, on a government bond starts to go lower. Now this means government bonds are less attractive for investors. And this moves on to the second key point. When the central bank is cutting interest rates and increasing the money supply, this means paper money in circulation is now going to lose its purchasing power because an increase in the money supply is being pumped into the system by the central bank to generate economic growth. But economic growth comes with inflation, and inflation erodes the purchasing power of paper money in circulation. And this is exactly why gold rises in value as soon as central banks slash interest rates to zero and increase the money supply, because bond investors can no longer hold government bonds paying low amount of interest during high inflation expectations, so they pivot and they pile money into gold as soon as central banks slash interest rates, because they want protection from inflation. And if gold jumps up 30-40%, well, then you're protected from that increase in the money supply. And stock markets rise at exactly the same time as soon as central banks cut interest rates, because now look what happens. Your everyday homeowner now pays less interest on their mortgage every single month. But not just a mortgage, credit card payments go down, car loan payments go down, student debt payments go down, personal loan payments go down. So consumers now have more money to spend, and investors know exactly what's coming. Higher earnings for companies. And that is why as soon as the central bank slashes interest rates to zero, stock markets bottom and take off on the expectations of higher earnings to start to come through in company reports in the near distant future. So understanding this fundamental relationship between interest rates, the stock markets, and gold is far more powerful than any technical analysis indicator or price action strategy you can ever use. So now you understand the pattern, here is exactly what we have to do next time the stock markets crash. When the stock market starts to fall because of weakening economic data, you need to reduce your holdings in high-risk assets like gold or stocks as the stock market starts to tumble. Then you need to build a nice cash position waiting for your entry. Now remember, don't rush to buy gold because it's going to fall alongside stocks until the central banks cut interest rates aggressively. So you have to watch the central bank's communications at upcoming meetings, and you have to watch very closely something called implied interest rates. So using our implied interest rate spreadsheet, analyzing the United States economy, we're going to know the exact month that the markets predict interest rates to hit their floor. And that's when we're going to know the markets are going to turn, because that will be the lowest level central banks are going to take the interest rate. And we know throughout history, that's when investors pile into the stock markets, pile into the gold, and start making their money. Now, as the markets continue to recover, keep building your positions in stocks and gold. And what you really want to do, you want to focus on sectors that turn around the fastest whenever the markets bottom and start to rise again. Then you want to use our macro spreadsheet to analyze the economic data to see that the recovery is taking shape and the economic data is recovering and getting better, and that's your green light to know that the stock markets are turning into a brand new bull market. So remember, the key to this, avoid FOMO. You have to let the economic data turn, and that's always going to be driven by central banks cutting interest rates. So don't jump the gun. Let the macroeconomic spreadsheet tell you what to do before you make your investments. So let's apply this framework to the current market conditions. Now, as of recording this video, we've recently seen on the news Donald Trump's trade policies, and we've seen the stock markets have quite an aggressive sell-off. Now, the Federal Reserve last year had already started cutting interest rates, and that was boosting the price of gold and the stock markets to record highs. Now, if we're looking at the economic data in America, the United States economy is definitely weakening, and investors are worried that we could go into a recession in the stock markets, and that would likely cause gold to also go down in value. Now, if this takes place, we already know what to do. The central bank is going to have to come and rescue the United States economy by cutting interest rates. So if the markets do crash, we know exactly when to get in and buy back at the bottom once the central bank cut interest rates. Now, even if the US central bank doesn't cut interest rates in the United States, as of this recording, the markets are still betting that the central bank is going to lower interest rates because they're coming from a very high place after COVID when they was trying to fight off inflation. So if Donald Trump does get trade deals done, if the central bank does have to lower interest rates because they've been high enough and they've got inflation under control, well, what's going to happen? The stock markets are going to continue to rise and gold is going to continue to rise. And that's why gold is at record highs right now and the stock markets are about 5 to 6% off its peak because the market is still waiting for a trade deal from Donald Trump's trading partners. So remember, this is more of an art than a science, okay? You have to be paying attention to what's happening in the live markets. We have to be analyzing the economic data. We need to be watching our spreadsheets to understand where is the central bank's interest rate going, because we know that is the driver that causes prices to move. So we now realize that stock market crashes are actually significant opportunities for us to grow our wealth, but only if you understand the fundamental drivers behind market movements. You have to have the emotional discipline not to panic, but to follow the plan. And you have to focus on the central bank's interest rate more than market sentiment. Even on the economic news, you'll hear them talking about doomsday. The markets are going to crash. They're going to go down another 20%, 30%. Fear mongering will take over because we're human and we're emotional creatures. But now you are equipped with the knowledge and the wisdom. You can push all the noise to the side and you can use the economic data, the central bank's interest rate as your guide to know when to get in. So think about it. If you would have bought the bottom of the stock market in COVID 2020, you would have doubled your money in less than a year. If you put your money in the bottom of the stock market in 2009, over the next 10 years, the stock market went up over 400%. That was the biggest bull market in American history. Now imagine how many times you could have been investing over that 10-year period. You would have got so wealthy, you would have had more money than you know what to do with.